Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, April 30th, 2010. The euro-dollar pair rose for a third straight day as we are getting closer to a deal on a rescue package for the Greek government. Greece needs to agree to 24 billion euros worth of austerity measures in order to win a potential 120 billion euro or $159 billion multi-year loan package. The news helped to ease the heavy risk aversion we saw midweek as we had the S&P downgrade the credit ratings of Greece, Portugal, and Spain, which spread fears of contagion of the Greek crisis. The decline in market sentiment and the sell-off of Greek and Portuguese bonds midweek gave new impetus to EU leaders, with even the recalcitrant Germany leaders saying a quick resolution was necessary. Today we saw the euro-dollar pair test its 200-period moving average in the 1-hour charts, and it hit a high at 133.40 before it turned around in New York morning trading as New York equity markets fell as they digested the news that a criminal investigation had been opened into Goldman Sachs. The pair fell to test its 100-period moving average, but then rebounded somewhat by the end of this week's trading. Expectations are for an announcement to the A deal within a few days, with many looking at Sunday as the most likely date. The pair has been under heavy pressure the last couple of weeks, and we'll see if we have a further relief rally as we come back for trading to start next week. So far, it has been rather timid, and we still have important resistance levels up until we hit this 136 level. Drawing a Fibonacci retracement of our full decline from that 1.3650 area, we see that today's high just hit the 38.2% retracement. Our next important level of support will be the 50% retracement level, which was also our resistance earlier in the week at around 134. So that will be our next key level to watch as we come back for trading next week. If we have some kind of snag in the negotiations and there is no deal finalized by the end of the weekend, then we could see the euro come under renewed pressure and retest this low we had for the week around 131. In data from the Eurozone today, we saw the flash CPI rise to 1.5% in annual terms for the month of April, which was higher than expected, but still is below the Eurozone, the ECB's target of 2%. The unemployment rate, meanwhile, for the month of March remained at an 11-year high of 10%. Now, while we did see European economic confidence improve to the highest in more than 2 years in April, the concern now is that the Greek crisis will spread and may prompt delays in hiring plans. There are also concerns that countries will rein in their spending in order to attack their fiscal deficits, and that may work to curb the economic recovery in the Eurozone. In the US, meanwhile, we had our advanced version of first quarter GDP, and the annualized rate showed the economy growing 3.2%, which was pretty much right where we had forecasted it. In the fourth quarter, we did rise by 5.6%, but in the first quarter, the gains were led primarily by personal consumption, which rose 3.6% compared to the fourth quarter's 1.6%. In the fourth quarter, a lot of the growth was a result of inventory buildup. The 3.6% increase in personal consumption amounted to 2.55 of the percentage points to the GDP growth. A second report, the Chicago PMI for the month of April, rose better than expected to 63.8 reading. All the key sub-indexes rose, including new orders, which jumped to 65.2 from 61.8, employment, which rose to 57.2 from 53.1, and prices paid, which rose to 71.4 from 66.6. The PMI is now at its highest level in 5 years. A third report from the U.S., the UMich Consumer Sentiment, the final version for the month of April, saw a 72.2 reading, which, while better than the preliminary release, which had a 69.5 reading, was lower than what we had seen in March. Both the current conditions and the expectations index declined compared to their March readings. As you can see from the chart to the right, we are stuck within a range within the last 5 months where consumer confidence has been unable to move higher. Now, with the GDP data coming in very close to expectations, it didn't have much of an effect on the market, and instead traders were more focused on the Goldman Sachs news, as we had the Dow Jones slide more than 1% and other key indexes in the US down more than 1% as well. Let's take a look at one of our currency pairs that is heavily reliant on risk sentiment, which is the US dollar, Canadian dollar. And despite oil prices actually positive today despite the risk aversion in U.S. equities. We saw the U.S. dollar Canadian dollar pair move in favor of the greenback in today's trading. We rose from 1.0014 all the way up to 1.0176, which came close to testing our highs earlier in the week after we had a bout of risk aversion when Greece and Portugal were downgraded by the S&P. We've seen this pair act rather choppy the last several weeks as we have had risk sentiment fluctuating back and forth. Here we had the Goldman Sachs news originally, which sent the pair in favor of the greenback, but then after a strong a hawkish Bank of Canada statement, the Canadian dollar gained again this week. We saw risk aversion rise in the middle of the week and now to end the week. We'll see if the greenback is able to hold these gains as the underlying fundamentals for Canada have not changed and interest rate expectations favor it compared to the greenback, as well as the fundamental data has been rather good for Canada recently. So we'll see if we have another fall back down when we come back to trading next week after our bout of risk aversion as we had the last two times in the last several weeks. Risk aversion also affected the Australian dollar US dollar pair, which after breaking a downward sloping resistance trend line overnight and reaching the 0.9322 area, slid back into its trading range we've seen the past several weeks, testing the 100 period moving average at the 0.9240 level in today's trading. That was if we draw a Fibonacci retracement of our most recent rally, that was a 38.2% correction to this move from 0.9135 up to 0.9320. Surprisingly, the New Zealand dollar actually had a rather strong performance today as it moved above this resistance level at 0.7250 to hit a high today of 0.7324. That extends the increase in the pair since Tuesday's low at 0.71. Taking a look at our gold chart, we see that today we had a rather strong increase as we touched the 1,180 level in today's trading. Gold prices continue to rally this week as gold is now being seen as a hedge against the uncertainty surrounding the Eurozone debt situation. The dollar-yen pair moved in favor of the greenback in overnight trading, moving above its high for this week at the 94.30 level, but we didn't move much past that resistance and fell back down in New York trading until we reached our 100-period moving average at the 93.87 level. We had some better household spending data from Japan, but deflation continues to be a problem. The Bank of Japan said they may take increased steps, which means further monetary easing, which should pressure the Japanese yen going forward. Finally, we take a look at the pound, and we see that it was unable to sustain its gains from yesterday's session as we topped out at 1.5389 in today's trading and fell back down below the 1.53 level to test our 50-period moving average in the 1-hour charts. Today's correction to yesterday's rally amounted to about a 50% correction. Stocks in the UK were rather weak, with the FTSE 100 closing down 1.2%, led by declines in Barclays Bank as well as British Petroleum. The pound dollar, similar to our other pairs, has been stuck in a trading range the past month or so, and right now we are squarely in the middle of that sideways range. Next week will be a pretty busy one in terms of fundamental data, and if we are able to put some of the Greek issues aside, if we have some kind of resolution on Sunday, maybe the currency markets will return to fundamental news as the primary driver. From the US, on Monday we're going to get data on personal incomes and spending, as well as the ISM manufacturing index. That's followed on Tuesday by pending home sales. On Wednesday we get data on the ADP employment change, as well as the ISM non-manufacturing index, which will be followed by Thursday's jobless claims data, and then Friday's ever-important non-farm employment change. A second strong month of job gains will go a long way to convincing people that the U.S. economic recovery is continuing to gather momentum. Around the world, we get two interest rate bank decisions on Tuesday. The first is the Reserve Bank of Australia, and on Thursday we get the European ECB decision. While we do have the UK data on manufacturing and services coming out this week, the main point of focus will be the UK election on Thursday. We also get employment data from both New Zealand on Wednesday as well as Canada on Friday. So that will wrap up our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site, FXTimes.com. I want to thank you for watching and wish you a good weekend.